In this video, we will discuss how to classify and calculate accumulated asset expenses called amortization, depletion, and depreciation. Amortization is the process of recognizing the expense accumulated from intangible assets over time. Intangible assets are corporate intellectual property, such as patents, trademarks, copyrights, and business methodologies, also goodwill and brand recognition. To find the expense, you must divide the amount the company paid for the patent, which in this case is $50,000, by the remaining years of legal life, 5 years. The patent decreases in value by $10,000 per year until the end of its legal life. The amortization expense of the patent for 1 year is recorded here. $10,000 is credited from patents, and $10,000 is debited to the amortization expense account. Depletion is the process of recognizing the expense accumulated from the physical use of assets by a company. Assets with depleting expenses are natural resources, such as timber, minerals, and oils from the earth. To calculate depletion, we'll use the example below. A mining company purchased a coal mine on January 1st for $2,800,000. The estimated capacity of the mine is 1,750,000 tons of coal, and the estimated salvage value is $1,000. They had extracted and sold 210,000 tons of coal from the mine. To find depletion, you subtract the salvage value from the cost and divide that by the estimated number of units, and then you multiply this number by the actual number of units. When you plug the numbers in, you find that the depletion expense for the month ending in January 31st is $335,880. To recognize this expense, you must credit the asset and debit the expense account.
Depreciation is the process of recognizing the expense accumulated from tangible assets over time. Tangible assets with depreciating expenses are from investing activities. Depreciation only affects plants, property, and equipment, also known as PPE. The two methods we will be using for calculating depreciation are straight line and double declining. The first type of depreciation calculation is straight line. This is when the same amount of depreciation is taken from each accounting period. We will calculate the depreciation of a delivery van for 1 year with straight line. We will use the example above. Sweets Bakery purchased a cake delivery van for $30,000 with a salvage value of $5,000 and a useful life of 8 years. So the equation we use is asset cost minus the salvage value over the useful life. So when we plug in the numbers, the depreciation per year is $3,125. And for each year for the next 8 years, they will record the same value. After the 8 years, there's a total of $25,000 depreciation. It is important to know that the net book value cannot fall below the salvage value. When using T accounts, you would record the $3,125 in accumulated depreciation as a credit and debit depreciation expense. Double declining depreciation produces more depreciation expense in the early years of an asset's life with the declining amount of expense in later years. We will use the same example from the straight line depreciation method for the double declining depreciation calculation. So first we have to find the straight line rate, which is 1 over the useful life, which is 1 over 8, and that equals 0.125. So then we multiply that number by 2 and we will get 25%. And we will multiply that by the net book value each year to find the depreciation expense. As you can see the table, the accumulated depreciation from each year is subtracted from 30,000, then multiplied by the rate of 25,000. At year 6, the accumulated depreciation was 24,660. Keep in mind again that the net book value cannot fall below the salvage value of 5,000. So for year 7, even though 5,340 multiplied by 25% is 1,335, depreciation expense has to be 339 because 30,000 minus the accumulated depreciation has to be equal to or greater than 5,000. The net book value is 30,000 minus 24,999, and that equals 5,001.